On behalf of Forbes Mazars and the ESOP team, I'd like to welcome everyone to today's webinar, Plan Sponsor ESOP Accounting Basics. As you may be aware, on June 1st, we officially launched a new global professional services network, Forbes Mazars. The firm is ranked among the largest public accounting firms in the United States, with 7,000 dedicated team members who provide assurance, tax, and consulting services for clients in all 50 states and internationally through the global network. Now, let me introduce today's presenters, Angela Fisher and Corey Vincent. Angela's area of focus is employee stock ownership plans in privately held companies. She assists with the structuring and facilitation process of creating new ESOPs. Angela's experience with ESOPs also includes providing financing assistance, tax planning, record keeping, repurchase planning, employee communication, and structuring of executive incentive plans. Corey is a member of the firm's commercial products and construction and real estate practices. He has more than 10 years of accounting and auditing experience and serves as engagement executive on numerous private equity, ESOP-owned, and family-owned companies. His experience includes audits, reviews, and other assurance services, employee benefit plan audits, mergers and acquisitions, and due diligence. I will now turn it over to Angela.
Thank you, Holly. And before we get into more of the bones of the presentation, I just really wanted to highlight a few of the learning objectives that we plan to cover both Corey and I in today's session. So first off, we're going to describe accounting for both leveraged and non-leveraged ESOPs for plan sponsors, which is the company. And then we're also going to touch on what are the different types of leveraged ESOP loans, because there are different couple of types, and then we'll kind of talk about what's most commonly used in today's ESOP environment. And then Corey's going to talk on the basics of repurchase obligation and how that affects a plan sponsor's financial statement. So repurchase obligation being when an ESOP participant terminates and they're eligible for a distribution of their vested balance. How does that affect a plan sponsor's financial statements? And then also thinking about what do the footnotes look like for an ESOP-owned company, and how do they change from pre-ESOP or pre-transaction into post-transaction when now you have a lot more disclosures that have to be provided with regards to the ESOP. So what is an ESOP? And I get this question a lot. It is an employee stock ownership program or plan, and it's a qualified retirement plan at its core. This is not an employee stock purchase program, so sometimes ESOPs get confused with employee stock purchase programs with the thought that with a purchase program, cash is coming out of an employee's paycheck to purchase shares of the plan sponsor of the company. Whereas with an ESOP, it is a qualified retirement plan, and nothing is actually coming out of participants' paychecks to fund the ESOP transaction. And instead, an ESOP is different because it can actually borrow money to purchase shares of the plan sponsor or of the company stock. And it is designed to invest primarily in the stock of that one company. So because an ESOP is a qualified retirement plan, ESOP participants are going to get a statement each year that shows what is in their retirement account. And that statement, it can have other assets, maybe some cash, but it's primarily focused on just holding or investing in stock of the plan sponsor. And so this is going to be different from some other profit sharing plans where you see a bunch of different assets within that plan. Whereas an ESOP, it is going to be financed through earnings of the company, and nothing is going to come out of a participant's paycheck, unlike a 401k where each paycheck something is withheld from a employee to buy those shares. Instead, what's happening is the ESOP is borrowing those funds to purchase that stock. Another kind of common misconception is that ESOP participants actually legally own the shares. And so that is not the case. Instead, what happens is that with an ESOP, a trust is formed, and that ESOP trust is the actual legal shareholder of the company or of that stock. and employees do not actually receive actual stock. Instead, what they receive is that beneficial ownership of the value of the stock that has been allocated to their account. So a lot of times when you speak with someone that works for an ESOP, they say, oh, we're 100% employee owned. And in a sense, that's correct, because if the ESOP trust owns 100% of the stock, then they are allocating 100% of the value of the company to those participants over a period of time. But in legal terms, it's the ESOP trust that is actually the legal shareholder of record and not those individual participants. Again, because this is a retirement plan, and the reason why this ESOP trust is created is really for a couple of different reasons, especially in terms of tax planning. We'll kind of talk about the tax benefits of an ESOP here in a few minutes. But it's also important to understand that because this is a qualified retirement plan, then it's going to be governed by the Internal Revenue Code, which is the IRS, and then it's also going to be governed by ERISA, which is the Department of Labor. So as we kind of move through today's presentation, I'll talk about okay, this is how ESOPs are typically structured because of interactions with the IRS and the DOL over the last 30 plus years. The way ESOPs are structured has tended to change over time. And so we'll talk about what we most commonly see now based off of that. And then where does GAAP come into play? How does GAAP read that, read that language of how it's being structured? So we'll kind of talk about some of the differences. So there are two forms of ESOPs. So there's a leveraged ESOP and then there's non-leveraged ESOP. And we'll start with the most simple of the ESOPs, and that is going to be the non-leveraged ESOP. So just as the name implies, in a non-leveraged, there is no borrowing of funds to purchase the stock. And instead, what happens is an ESOP trust, an ESOP plan is created, and how it receives shares is through contributions of either new company stock or stock from Treasury. And they receive those stock contributions on an annual basis from the plan sponsor. So it could be stock contributions or it could be cash contributions. In more today's terms, you probably hear this referred to as a contributory ESOP. Contributory ESOPs are becoming more and more popular with certain facts and circumstances. For instance, we're seeing more contributory ESOPs in the banking industry. So for banks or financial institutions that are looking for an ownership succession model, but also wanting to reward their employees, especially the long-term ones, they are implementing contributory ESOPs to start that transition, because it is harder to do a leveraged ESOP in those situations when banks have such heavy capital requirements from the regulators. And so contributory ESOPs are a means of helping with that ownership transition, and then also helping those long-term employees get some stake in the company over a period of time. And you also tend to see these types of ESOPs in what I consider the more mature ESOPs that are maybe 20 or 30 years old. So back when ESOPs were initially in place, these internal loans weren't necessarily as long as they are now. And so there is coming to a point in time when ESOPs that have been around for a while are no longer leveraged. So maybe they've paid off that internal loan. And so now we would consider them non-leveraged because that internal loan has been fully satisfied. And so again, a way to still consider it an ESOP and to still be a qualified retirement plan, you're seeing more stock contributions or cash contributions going into the ESOP. And so those tend to be where you see the non-leveraged ESOPs or contributory ESOPs the most. And I would also say it tends to be in the partial ESOP, so maybe not a significant stake, maybe a minority ESOP tends to be more contributory. For example, some companies say, well, let me just kind of kickstart the ESOP in the beginning and do contributory for a couple of years before we decide to do a full leverage transaction. And so they just contribute maybe a couple percentage of the company value to the ESOP each year, and then in a couple of years they'll plan to do a larger leverage transaction. So you are seeing more and more non-leveraged ESOPs. It's just not as popular, particularly in those that are going from 0 to 100% ESOP owned. But what is nice about non-leveraged ESOPs, right? I talked about how simple they can be. And from an accounting perspective, really just the cash or the stock that is contributed by the plan sponsor is going to be reported as what we call ESOP compensation expense. So the value of that asset or that cash that is being contributed to the ESOP by the company is going to be reflected as an expense on your income statement for the value of that. And what's nice is right, we talk about it, it's simple. And so just whatever the value that was transferred, that's going to be your expense for both GAAP and actually for tax as well. So leveraged ESOPs, and this is where we're going to spend the bulk of the presentation today, is kind of talking about, well, what is a leveraged ESOP? What are the different types? What are the accounting for it? And how do your financial statements and footnotes change? But first I wanted to kind of walk through when you typically see a leveraged ESOP. And so right, in a leveraged ESOP, the ESOP is borrowing money to purchase shares from those selling shareholders. And so it is going to be in some ways very similar to a traditional leveraged buyout. So it can be a management team leveraged buyout or maybe some other third party. With the exception that with an ESOP, there are what I consider 3 or 4 main benefits that you don't see in other traditional leveraged buyouts. So first and foremost, in a leveraged ESOP purchase, a selling shareholder is able to continue to manage the business, to mentor that next generation management team, and to continue to work for the company. A lot of times in a leveraged buyout, particularly a 100% buyout, that selling shareholder would no longer work for the company, and instead they would move on. Whereas with an ESOP, those owners generally continue to stay working for the company. What I would consider the second and third benefit is really the tax benefits that ESOPs provide that you do not see in traditional leveraged buyouts or a management buyout, both for the company and for the seller. And maybe let's start with the company because that's what most people know at this point. So if an ESOP owns 100% of the stock of an S corporation, then the company's earnings are exempt from federal and most state income taxes. So think about every 40 to 50 cents that a company makes is generally going to shareholders for them to pay their tax or quarterly estimated tax payments. And if a company no longer has to do that, then it's able to finance this ESOP transaction, this leveraged ESOP, much quicker than a management buyout or other third party could. And so how we kind of also transition that to benefits of the seller, because an ESOP does not care about those tax distributions. They are willing to purchase stock of a company because they're not looking for a step up in basis to get more depreciation. They don't care about depreciation. And so those sellers are able to sell their stock, which is going to be taxed at capital gain. And if they've held their shares for a year and a day, then it's taxed at long-term capital gain rates, which we all know right now are at much more favorable rates than ordinary rates. Additionally, and we'll talk about this in a little bit, but that seller can also recognize installment gain or installment treatment from that sale of the stock to the ESOP. And then lastly, what I would consider a big benefit of selling to an ESOP in a leverage transaction is that over time, the wealth of the company is going to be transferred to a broad-based employee pool. So right now, the stock is maybe held within the family group, and that family group holds all of the wealth of that company. Whereas with an ESOP, once it sells to an ESOP, or once the stock has been sold to the ESOP, then the wealth of the company is being transferred to really broad-based employee ownership. And that's where you hear people talk about we're 100% ESOP owned, and this is from that mentality. So we've talked conceptually about how leveraged ESOPs work, but I wanted to actually show you what it looks more graphically and kind of show you how the cash changes hands, where the notes are sitting, and then really what an initial ESOP transaction or an initial leveraged ESOP transaction works. And so there's going to be a lender, and that lender is going to be either a combination of a bank or a financial institution and the seller. And they are going to lend to the company because the company is really, the plan sponsor, and it's the entity that holds all of the collateral and that holds all of the employees that generate the operating revenue of the company. And so the lender is going to lend to the company. And so the debt of the transaction, like the true cash that is changing hands, is going to sit at the company or the plan sponsor level book. So just like any other debt, whenever you go to a bank and say, I would like $5 million, that $5 million is going to be shown as a note payable on the plan sponsor's books. And so no difference here. But remember, we're trying to get the shares into the ESOP. And so the lender or the bank and the sellers lend to the company, and then the company is going to lend to the ESOP, because on day one, the ESOP is really just an unfunded retirement plan. It has no source of financing or generating revenue except through contributions from the company. And so, right, you have the lender lending to the company, and then the company is going to lend to the ESOP, where then they purchase the shares from the sellers. And so what it actually looks like in terms of notes and the debt and kind of how these are generated is there's going to be two separate sets of notes. So on the left side here is what I like to call the real debt, the debt between the bank and the seller and the company. And so this debt is going to pay off as quickly as possible based off of the cash flow stream of the company. And so that is generally what I see about 7 to 10 years. And so a couple of things to think about whenever we're thinking about this external debt of the transaction. So a lot of times I have sellers that wish to sell 100% of their stock to the ESOP. And they say, I do not want to take any bank financing because maybe I've already leveraged up the company based off of my receivables and my fixed assets and my inventory, and there's not a lot of room for additional leverage. So I would just like to seller finance the whole thing. And then we also have some sellers that say, I want to seller finance the whole thing simply because I want to keep my bank and my bonding company happy, knowing that seller debt is going to be subordinated to a bank and bonding company if you're in the construction space. And so it tends to be viewed more favorably. So Corey's probably going to talk about covenants that you have with your bank and bonding company. And so because the seller notes are subordinated, they are viewed more friendly and tend to be add backs in some of those covenants. And then you also have some sellers that say, I would like to get some bank financing. And that is perfectly acceptable. And so a bank would look at the amount of leverage that a company already has. They're going to look at the receivables. They're going to look at fixed assets. They're going to look at inventory to know how much they can realistically lend to fund some of the transaction. And in this situation, generally that bank debt tries to repay over, call it a 2 to 5 year period of time. And while the bank debt is outstanding, I think it's important for sellers to understand that typically, while the bank debt is outstanding, all of the principal payments would go towards that bank debt, and no principal payments would go towards the seller debt. Instead, it would be interest only during that period of time. But again, each seller can do it differently. It's still the mentality, though, that someone is lending to the company to fund this transaction, and the debt, the real debt, is actually going to be sitting on the plan sponsor books. And we talked about that the ESOP is exempt from federal and most state income taxes. So every 40 to 50 cents that the company was paying to the shareholders to fund their tax distributions are no longer occurring. And instead, it's using that tax-free cash flow that it's saved to help pay down the debt of the transaction. And that is really the mechanism that allows ESOP transactions to pay off over a much quicker period of time. So that's the external debt. Now, on the right side of the slide is the internal debt. So we talk about leveraged ESOPs, and this is more of an area where people tend to get confused of how does this look like on the books of the plan sponsor. And so this is the internal loan between the company and the ESOP, where the ESOP on day one is just the unfunded retirement plan. And on day one, all of the shares that it purchased from the selling shareholders are held in what's called a suspense account, meaning it is not allocated to any specific person or participant, and instead it's going to be allocated over a period of time. Now, this period of time is generally going to be at least 30 years, particularly in the 0 to 100% transactions that we see. But we'll talk about in a little bit kind of the mechanisms of how does this internal loan actually work and why is it structured over a much longer period of time. So I'm going to flip on over to our first polling question, which is, what is it called when an ESOP borrows money to purchase stock? So is it a management buyout, a third-party sale, a leveraged ESOP transaction, or I don't know? And a lot of times when I'm working with owners and they're wanting to look at an ESOP and do some feasibility modeling, they also say, well, I do have a group of 3 to 5 management team members that would also love to consider buying me out. Can we model what that would look like? And I can tell you that, we model it, but I can tell you without modeling it what it's going to look like. And it just takes so much longer to repay that management buyout than it does an ESOP transaction, simply because of those tax benefits. A lot of times it could be double the amount of time. And so I think it's always important to understand what are the overall goals and objectives of achieving this ownership transition. Is an ESOP overall what the owners want, or kind of what do they envision as that transition model? And so the answer is a leveraged ESOP transaction. So good job, 77.3%. So the internal loan, and so this is kind of the right side of that slide that I mentioned before. And so this is going to have no cash flow impact to the company. And it's also going to be a means for getting a tax deduction, and then also a means of getting shares into participants' accounts. And so what happens is, we talked about it's structured over at least a 30-year period of time. And so what happens is each year the company is going to make a cash contribution to the ESOP, and then the ESOP says, well, I owe you that much money back in the form of a loan payment. So they'll send it back to the company. So from a company perspective, there's no cash actually leaving. But what happens is when the cash goes to the ESOP, that's what creates a tax deduction for the company. And so if you're a partial ESOP, that tax deduction can be very beneficial to the company in terms of calculating its taxable income. And then whenever it gets sent back to the company in the form of that loan payment, that's the mechanism that is releasing shares from suspense into eligible participants' accounts. And so whenever you are setting up a new ESOP, I think it's important that whoever advisor is helping you is really running through the traps of how should a transaction be structured? How should that internal loan be structured? Because of the second bullet point here in the middle, its contributions are going to be limited from a tax perspective to 25% of eligible compensation. And so if you have a company that generates a lot of value compared to the number of people that it takes to generate that value, I have some clients that generate millions and millions of dollars, but it only takes 20 to 30 people to generate that. And so they run into this 25% of compensation limit. It's called Section 404. And really what happens is you need to do enough modeling on the front end to know how should the transaction be scheduled or be structured. So should the entire purchase price be considered an ESOP loan, that ESOP internal loan, or should the company do a substantial redemption on the front end and then have the ESOP purchase a nominal value at the back end? So there has been different plays of how a transaction has been scheduled to help with this 25% limitation. So I think if you're looking to do a leveraged ESOP in the near future, making sure that you're running through those traps is going to be beneficial. And then also, as you are thinking about how long that internal loan needs to be. So we talked about that it's at least a minimum of 30 years. Anymore, we're seeing 40, 50, 60-year internal loans. So they keep getting longer. And that's really just a function of what is the value that the company is allocating to participants each year from that internal loan. How much value is going into participants' accounts as a percentage of their compensation. So if you think about it, if that loan was shorter, let's say if it was 20 years, then you're releasing more shares at a quicker rate. And so that is giving more benefit to participants on an annual basis. Whereas if you structured it over a longer period of time, then it would slow down the benefits. And so typically what we like to see is structuring it over a longer period of time. And then maybe in the beginning when that contribution rate is not as high, right? Again, because if you go from 0 to 100%, you've just leveraged up the company. So the value maybe isn't there. And so to help kind of boost the benefit levels in the early years, you may make a prepayment on that internal loan. And so it's easier to set up this loan to be structured over a longer period of time and then make prepayments in the beginning than it is to structure it over a short period of time, realize that you are giving too much to participants too quickly, and then have to restructure that loan. But I think it's important to understand that the external debt, which is the debt that's actually, on the company books that is used to fund the transaction from the sellers, they have that debt has no impact or really no correlation to the debt that is going to sit on the plan financials and be shown as that internal loan. And really, what are the different types of internal loans? So there's three types, but really the middle two can kind of be used interchangeably. And that is what we typically see most often, is that the company is going to loan to the ESOP, and then there's going to be, and Corey's going to talk about it, this contra equity account that's going to be reflected on the plan sponsor books. But just know that that is most commonly what your leveraged ESOP probably is. I will say about 1% of ESOPs that I see use the direct method, to where the lender or the selling shareholders actually make a loan directly to the ESOP. That I'm not saying there's no situation to where that would work, but I just know that I've seen a lot of instances where those do not work, simply because that selling shareholder and the bank want to be repaid as quickly as possible. So if you are paying them back as quickly as possible, then that means shares are being released as quickly as possible as well. And so that is why you typically do not see direct loans. I have seen some out there, but typically you see the internal loans, because you're trying to really drag out the value of the company being allocated to participants over a period of time. And now I'm going to turn it over to Corey. So I talked about kind of the different types of leveraged ESOPs and really when they're the most common, and now Corey's going to talk more about the accounting behind them.
Yeah, thank you, Angela, for that overview on the mechanics of an ESOP, along with considerations that people need to think of on the front end. So over the next several slides, I'm going to walk you through the basics of accounting for an ESOP transaction. We're going to cover some common terminology for ESOPs. We're going to look at an example balance sheet and income statement, and then go over some specific accounting entries that will be made. And then lastly, we're just going to discuss other considerations you should know about being an ESOP and go over the required disclosures. So first, just as an overall, I wanted to provide the specific accounting guidance that actually governs the accounting for ESOPs, which is ASC 718-40 from the codification. And now, before we get into the meat and potatoes here, let's go to one more polling question based on what Angela just covered. Which of the following are company loan options? You have A, traditional bank financing, B, seller financing, C, third-party alternative financing, or D, you don't know. Give you just a minute here to answer this question. And while we're waiting, just another reminder that the following that we're going to be covering is the basics, very basics of an ESOP accounting transaction. Every transaction can be slightly different, and some can be very complex. So it's just important to consult and seek out your trusted advisor whenever it comes to your ESOP. And if you don't have one, we'd be happy to connect with you. So. A few more minutes or seconds here. All right, so looks like most people went with traditional bank financing. All three answers would have been correct, so can't get it wrong here, but traditional bank financing is probably the most common, so good job everyone on that. All right, so the first term that I wanted to go over, and Angela alluded to it, was unearned ESOP compensation account. So as Angela mentioned, this is a contra equity account that represents the initial purchase price of the shares held by the ESOP. So very often on day one of the ESOP, this amount is going to be the same as the internal loan. However, big bold letters here, important to note, after day one, this account will not represent the internal loan balance, and it will not be the same as that internal loan balance. So subsequent to day one, this account is always going to represent the number of unallocated shares, or those shares held in suspense, multiplied by the historical purchase price of those shares. So another great check figure from the GAAP side to make sure that you've recorded things properly. We're going to discuss unallocated shares here in a couple minutes. So for new ESOPs, though, this will be a brand new account on their balance sheet. And let's just go over an example of the initial ESOP accounting entry. Okay, so our example is going to take place on January 1st, 2024, and in it, the ESOP purchased 100,000 shares for $14 million, which equates to about $140 per share. So in this example, we're going to assume it was funded 100% through term notes. In this initial transaction, the company would debit unearned ESOP shares for $14 million, which, as you can see on the sample balance sheet here, it is a contra equity account. And it will credit acquisition term notes for $14 million as well as the liability. So something I think is important to note is that the unearned ESOP shares account at the initial transaction should represent the amount of consideration the ESOP paid for those shares. So in our example, it was 100% financed through term notes. However, some transactions could include cash, could include other debt instruments as part of the transaction. And another thing that we see very common in ESOP transactions is a redemption of stock prior to that ESOP transaction that really happens simultaneously. So, however, it's just important to remember the only thing that should be included in the unearned shares account is the actual value paid by the plan for those shares. All right, so a couple other terms that are common within the ESOP space. I'm going to talk about the different types of shares. So the first is allocated shares, which are the shares that have been assigned to participant accounts. To me, these are the shares that really drive excitement within the business. These are the shares that the participants are going to see added to their annual statements. So more increase as we make these debt service payments, these shares are going to be allocated to participants. So the next term is committed to be released shares. These are the shares that have not been legally released to date, but will be released by a scheduled and committed debt service payment in the future. However, it's important to note that these will be allocated to participants and employees for service rendered during that accounting period. So typically we see the debt service payment made on the internal loan prior to year end. But then there are instances where it could be paid subsequent to year end, but we're still going to allocate those shares for that current accounting period. Lastly, we have suspense shares, which we've discussed. Another name for this would be unallocated shares. These are the shares that the ESOP has that have not been released, committed to be released, or allocated to participant accounts. These shares are generally serving as the collateral for that ESOP debt. And these are going to be released in the future periods as other debt service payments are made. All right, the next term I wanted to cover was compensation expense. And after this, we're going to walk through an example on how it's calculated and recorded. But generally, the company records compensation expense annually based on the number of shares committed to be released or actually released to participants for services performed during that period, multiplied by the fair value of the stock. So important note on fair value, that's typically determined by a third-party valuation group, and it's approved by your trustee. It's going to be determined based on the average of the stock value during the period. So there's a little bit of diversity in practice that we see some entities using the actual year-end value opposed to the average value for the year. And we really see that because typically that debt service payment is made at the end of year or towards the end of year. And then also that year of end kind of encompasses the annual performance. So a little bit of diversity in practice there. Big thing to remember, though, it's important to discuss your methodology, whether you're using the average or the year-end value with your trusted advisor, with your accounting team, to make sure everyone is on the same page for recording the transaction. So, and then once you select one, you should stay consistent with that on an annual basis. So compensation expense should be presented as an above-the-line operating expense on the statement of income. We typically see this as its own financial statement line item within operating expenses. However, if it's not broken out separately, the readers can see the amount either on the statement of cash flow or in the footnote disclosures. And that's important for the readers because that's typically an add back item that's non-cash. So. All right, so let's take a look at an example for a recurring ESOP entry and then spend a little bit of time talking about how to properly record the annual release of shares. So this example is going to piggyback off our previous example facts as well. So at the end of the year, the ESOP makes a debt service payment on the internal ESOP loan that's going to release 2,000 shares from suspense account. So if you remember, initially we had 100,000 shares at the ESOP transaction date. So these 2,000 shares are going to be allocated to participant accounts. And here we're going to assume the price at the beginning of the year was $150 per share, and the price at the end of the year was $165 per share. Therefore, the average price during the year was $157.50. As we previously discussed, ESOP compensation expense is going to be calculated using the number of shares released, which is 2,000, multiplied by this average share price, $157.50. So as a result, the company would debit ESOP compensation expense for $315,000. The next part of the entry that I like to focus on would be the unearned ESOP shares, which is going to be maintained at the original cost. And if you remember from our previous example, was $140 per share. So as such, the company will credit unearned ESOP shares by $280,000, which is the 140 original cost multiplied by the 2,000 shares released. This leaves you a difference between the two line items, and hopefully the fair value of the shares continue to increase and will be greater than the historical cost, which is what we're showing here in the example. And as a result, generally that difference is going to be a credit to additional paid-in capital. Another way to look at it is if you take the difference in the ESOP compensation expense and the unearned ESOP shares prices. So here we have $157.50, that less $140 with the original cost. That's going to be $17.50 times the 2,000 shares. That also gets you your $35,000 credit to additional paid-in capital. And then just one other thing to note, it's not in this example, but if the current value is less than that original cost, then you would debit additional paid-in capital, not to exceed or go below zero. And once you hit zero, at that point, you would be debiting retained earnings. All right, so let's take a look at this entry on our income statement. So as you can see in the income statement example here, ESOP compensation expense was debited for $315,000 and is included above the line as an operating expense. And here we've distinguished it separately from other SG&A expenses. Right? We're going to look at the balance sheet for that same example. So the first column, that was the previous balance sheet that we looked at post-closing of the ESOP transaction. The second column is some general activity of the company. And the third column is the result of this entry that we just made for the debt service payment and shares being released. So as we discussed, we reduced unearned ESOP shares by 280,000. And just as a reminder, as I mentioned earlier, the ending balance in unearned ESOP shares should be the amount of shares in suspense times the original cost. So we have 98,000 shares remaining multiplied by the $140 original cost. That's going to get us 13,720,000, which, as you can see in the example, is the ending balance in our unearned ESOP shares. And then you can also see the impact on additional paid-in capital and the retained earnings for the ESOP compensation expense. And then while we have the balance sheet here, just want to hit a couple other things that we see that's common in ESOP transaction. That's going to be the issuance of warrants, stock appreciation rights, or incentive stock options. A lot of times we'll see those granted in connection with an ESOP transaction or maybe subsequent to an ESOP transaction. These items, while they're not shown in the above example, would have specific accounting entries that needed to be made post-close and then also on a recurring basis. So definitely things you should consult your accounting firm or other advisors if you have these things present in your ESOP transaction. All right, a couple more terms that we're going to go over. So next slide is dividends and distributions. So as a general rule, cash dividends and distributions on allocated shares are recorded as dividends within the statement of stockholders' equity of the sponsor company's financial statements. And then cash dividends and distributions on unallocated shares are typically recorded as a component of compensation expense on the income statement. So there could be some other factors to consider that could impact how these are treated, but these are generally good rules of thumb. And it's also important to note that if cash is received from dividends on allocated shares that is used to fund the internal loan debt service, that cash has to be replaced with an asset of equal value, so which is generally more shares. So this would typically release more shares because you're replacing those with shares, which in turn creates more compensation expense. All right. So some additional considerations. One is if cash is contributed to the ESOP that's not returned as part of the debt service. So an example of this would be cash contributed to the plan to be used for repurchase obligations instead of that debt service payment. It would be treated as a contribution expense subject to IRS regulations, or as a dividend distribution as we discussed on this previous slide. So generally, when cash is contributed for the repurchase shares and those shares are not re-leveraged, that is going to be shown as ESOP compensation expense on the sponsor company's financial statements. But again, depending on the mechanics of the transaction, the accounting can vary slightly and be more complex. Then, as I mentioned, typical to see synthetic equity, warrants, ISOs, SARs to be issued to former owners and management, key personnel within the company, in order to incentivize. Typically, these are going to have longer vesting periods in order for management or previous owners to stick around post ESOP transaction and help lead the business still and continue to grow value. Then lastly, another important thing to remember is what your financial statements are going to look like post closing of the ESOP transaction. So typically, they're going to look much different, and it's important to form and consult with all readers of the financials to understand this impact. So this would include your creditor, so your bank, current bank, and the impacts that it's going to have on financial covenants, key performance indicators, including timing of such covenants. So with the additional complexities of an ESOP and having to get an annual valuation performed, sometimes the reporting requirements with creditors are extended out. Typically we might see 120, 150, even 180 days for reporting requirements to allow the audit review to take place, to allow the valuation company time to complete their work, and then also to allow the management and trustee of the ESOP to review and approve the fair value. Then additionally, one thing that's very common in a leveraged ESOP transaction is for your equity to turn negative post-close. And that's really due to that unearned ESOP shares account, which is a big debit in your equity. So it's a contra equity. So that's something else that creditors and other users, whether it be bonding, whether it be, governmental departments that you have to submit your financials to, that's something important for them to know that you are going to have net equity. And sometimes just due to ESOP compensation expense, your income statement could put you in a loss position. And that's also something that they need to be aware of. All right. So I think the main thing there is just to make sure everyone is on the same page early on in the process and to get all the parties together before you enter into an ESOP transaction, allows everyone to voice any concerns and then allows you to discuss and adjust things appropriately. All right, so we're going to dive in a little deeper on repurchase obligations. So Angela touched base on this just a little bit earlier, but wanted to revisit it. Participants are entitled to receive cash equal to the fair value of stock allocated to the participant account upon a distributable event. That distributable event is usually defined in the ESOP plan document. So as they have that right to receive that cash, that creates what we call a repurchase obligation. And under the Internal Revenue Code, the company, the sponsor company, not the ESOP itself, is required to provide enough cash to the plan so that the ESOP can meet those distribution requirements. So before we go in deeper, let's go into another polling question here. And then we'll come back to repurchase obligations. So which of the following is true regarding ESOP compensation expense? We have A, it is equal to the net cash transferred to the ESOP. B, it is based on the number of shares released and the fair market value. C, it is reported below or outside of operating income. Or D, I don't know. And as we've talked about these debt service payments and the contribution that the sponsor company makes to the ESOP, one important thing to note is that those are two separate cash transactions. So cash actually needs to flow on that. It's not just a paper entry to show that cash thing. So we actually need to cut checks. Company needs to write one to the plan, and the plan needs to write one back to the company. It's a pretty common question that we get with that ESOP and the internal loan. So. All right, results here. Looks like for the most part, everyone got it. It is B, based on the number of shares released and the fair market value. All right. So we'll get back into repurchase obligation. So again, it's the sponsor company who has the fiduciary responsibility to plan for and manage this repurchase liability. So as such, it's important to monitor your potential repurchase obligation. And as a general rule, we typically recommend mature ESOPs to have a repurchase obligation study conducted maybe every 3 years or so. Angela can provide a little more insight on that as she helps with repurchase obligation studies, can provide what that life cycle looks like throughout ESOPs and how to manage that effectively. But it's definitely something you want to be made aware of. And while it's named a repurchase obligation and it is the company's responsibility, the actual amount of this obligation is not recorded as a liability on the plan sponsor's balance sheet for private companies. There is public companies, do have an option to report that. But so the plan sponsor has to disclose it in their financial statements, though. An example of that would be the company is obligated at the option of each beneficiary to repurchase shares of the ESOP upon the beneficiary's termination or after retirement. At December 31st, 2024, the fair value of the 2,000 allocated shares of the ESOP is approximately $330,000. So that was from our example, what an example disclosure would be. All right, so we're going to get into some footnote disclosures. It's kind of the last part that I wanted to hit. So included in the financial statement footnotes, the company has to disclose a description of the plan, the basis for determining contributions, and the employee groups covered. An example would be, the company sponsors a leveraged employee stock ownership plan that covers substantially all employees who work more than 1,000 hours per year. The company makes annual contributions to the ESOP equal to the ESOP's debt service. So that was an example disclosure. And then in addition to that, you have to describe the accounting policies that the ESOP transaction follows for transaction, the method of measuring compensation, classification of dividends on ESOP shares, and the treatment of ESOP shares for earnings per share computation. That's if it's applicable. Typically with the earnings per share, that's required only for publicly traded companies. All right, other things to note. So the company should disclose the amount of compensation expense recognized during the year. They also should disclose the number of allocated, committed to be released, and suspense shares held by the ESOP as of the balance sheet date. And then they also should disclose the fair value of unearned ESOP shares at the balance sheet date. So in our client base, we typically see these in a tabular format that shows compensation costs comparatively between both years that we're presenting, and then also a roll forward of share activity with beginning share balance, release shares, and unreleased shares. And then also, as we mentioned, you have to disclose the nature of that repurchase obligation, including the fair value of the shares allocated as of the balance sheet date. And again, just another important thing is that you have to disclose that amount, but it's not recorded as a liability on your financial statements for the repurchase obligation. All right, so as you can tell, ESOPs and their very nature can be very complex. This is not something that should be taken lightly by management. And as we've discussed, it's crucial to make sure you're bringing all your advisors to the table at the beginning if you're thinking about using an ESOP as your succession planning tool. So the sponsor company should be engaging in qualified legal and financial advisors to help think about all the different aspects of an ESOP and the impacts that it's going to have on the sponsor company and its employees. So at the beginning, you'll want qualified advisors to help you with internal loan considerations, how to set up the ESOP appropriately, how it should be financed. You'll want to make sure your bank is involved, as they're the ones that likely have to sign off on the transaction. This is especially true if it's 100% leveraged ESOP, as that's going to trigger a change in control provision, which is likely included in your credit agreement. You'll want financial advisors and ESOP consultants to help you know all the possibilities of your ESOP. What are ways that we can motivate and incentivize sellers and key management members, again, through those synthetic equity instruments. Then you also just want to make sure it's properly accounted for on the front end. Each ESOP transaction is a little unique and different, and some small differences can have different accounting entries and impact on the financials. And then subsequent to, as we've discussed, there's numerous things that the sponsor company should be monitoring and seeking advice on to ensure the ESOP continues to grow in value for the better of its participants. All right, last polling question here. Made you wait to the end to get this fourth one in. Would you like to schedule time to further discuss one of the topics below with the presenter? So we do have accounting for non-leveraged ESOPs, accounting for leveraged ESOPs, required footnote disclosures, or just not currently, but maybe in the future. So I think we're going to open it up here for some questions. If any has came in, or if Angela, if you have any closing thoughts here.
We do have some questions. The first one is an ESOP the same as an employee stock purchase plan?
So an employee stock purchase plan is not the same as an ESOP, which is an employee stock ownership plan. And so with a purchase program, actual funds are withheld from an employee's paychecks to buy the shares of the company, whereas an ESOP is more meant to be a retirement plan. And so nothing is coming out of a participant's paycheck, each paycheck, and instead it's really being financed through contributions from the employer to the plan, right? We talked about each year the plan or the company is going to send contributions to the ESOP, and then the ESOP is going to turn around and send that back in the form of a loan payment, and that is how shares are allocated to participants. So there is a difference. I know sometimes it gets confusing, but I think it's important to understand with an ESOP, nothing is coming out of a participant's paycheck, whereas with a like an ESPP, there actually is funds withheld from a person's paycheck in order to purchase those shares.
Okay, great. Here's another question. Can you talk about the tax benefits of an S-Corp ESOP? Yes, so I know I touched a little bit on the tax benefits earlier, but I think the one that, in terms of tax, what people know most is that if an ESOP is owned 100% by, or if a company, an S corporation, is owned 100% by an ESOP, then it is going to be exempt from federal and most state income taxes. So the ESOP is still going to get a K-1, but that K-1 is really just reported within the record keeping of the ESOP plan. Whereas right now, if you're an S corporation and you're an individual that owns the S corp, you're receiving a K-1 and you're reporting all of those earnings onto your respective individual income tax return. And so that's whenever you're paying the income taxes. But because the ESOP is a qualified retirement plan, it is not paying income taxes. So all of the earnings in a 100% scenario are going to be exempt from federal and most state income taxes. Now, if you are a partial
S ESOP, the earnings attributable to the ESOP are still going to be exempt from federal income tax. I think the common misconception, though, is because S corporation rules state that distributions must be pro rata. So if you're an individual and you're receiving tax distributions from the company, well, then the ESOP is going to need their pro rata piece of the distributions as well. They may not be using that cash to pay taxes. They could be using it to fund repurchase obligation or maybe to fund a second or third stage ESOP transaction, but it would still receive its pro rata piece. And so I think those are commonly the big benefits that you see from a tax perspective for an S ESOP. I would also say because each year the company is making a contribution to the ESOP to fund that loan payment, that contribution is going to allow them to get a tax deduction for that contribution. So for GAAP purposes, you're reporting the fair market value of those shares that are being released. But for tax purposes, you're going to get a deduction for the cash that was contributed. But because the loan payment includes an interest piece, then the S Corp would need to pick up that interest income on the books as well. But there are a lot of tax benefits, right? If you're 100% S ESOP, then you're not paying federal income tax, which can really create a lot of opportunity for growth and acquisitions for an ESOP.
Okay, we do have another question. Should the principal balance on the internal loan equal the balance of my unearned shares account?
Corey,
Only on day one. Only on day one. Yeah. After that, it is not going to be the same. That unearned ESOP is always going to be at the historical value and the amount of shares in the suspense account. So.
Okay, I think we have time for one more question. How often do I need to record the entry for ESOP compensation expense? Do I have to record it before sending the trial balance to our CPA form, or will they help me?
Yeah, I mean, there's difference in practice here. Some companies will not record it until they have the current year value. You know, typically what we like to see is that it is recorded prior to getting the trial balance, either at maybe the prior year valuation amount or an estimated or projected current year value, just to get, again, that ESOP compensation expense on the income statement and to get some movement in your unearned shares ESOP. So difference in practice, no really wrong answer to that, but I think, you know, just so there's no late surprises, it is better to record that at least once a year and prior to sending the trial balance.
Great. Well, thank you again for joining us, and be sure and register for our second webinar on August 8th, Plan Sponsor ESOP Accounting Advanced Sponsor Topics. You can visit the registration information on forbesmazars.us.